You're welcome. In this chapter, we want to look at current issues that are happening in the audit world. All right, because the world is dynamic, accounting profession is dynamic, auditing is dynamic, business is dynamic, technology is dynamic. All right, so the bodies responsible for producing auditing standards too, they are not sitting still. All right, so as a student, you need to know what is happening globally. All right, for example, the issue of climate change, all right, is a serious issue in the developed world now. Now we have what is issues like uh, carbon trading, okay, whereby a company is given a particular limit of how much carbon emission you can release into the environment. So once you exceed, and they have a way of measuring this emission, so once you exceed that emission, you have to pay. All right, you have to pay. Government will charge you. All right, once you discharge into the atmosphere and beyond that particular threshold, because it is believed for every emission or carbon, all the smoke and the rest of it that you are discharging into the air, all right, it is going to affect everybody in the world at the end of the day. All right, so climate change, green technologies, all right, use of solar, okay, solar, wind energy to generate light. Okay, why is it that coal is no longer being encouraged to be used, all right, to generate energy? Because it will affect the environment. Why is it that fossil fuels or like petroleum, now some countries are saying no, we cannot use petroleum, they are now having electric cars. All right, you're having electric cars, you're having electric train, all right, because of the concern for the environment. All right, so ethical issues, you need to be aware about it. Okay, we've talked about the ICAN code of ethics. All right, as a chartered accountant, you must have integrity, you must be objective, you must be professionally competent, you must demonstrate confidentiality, and you must demonstrate professional behavior. Of course, when it comes to all this ethical framework, you can use a rule-based framework, you can use a principle-based framework. All right, rule-based framework means that you need to create a checklist for every situation that an accountant will meet, and check whether he has meet up with that requirement or not. Of course, the rule book system is not going to work, because there is no rule book that can define all the situation in which the accountant is going to find himself or herself in the professional field. All right, so which means, if the accountant finds himself in a situation that is not covered by the rule book, he can do whatever he wants. And that is why in ICAN we have chosen the principle base. All right, which is just 5. All right, you can adapt that to wherever you find yourself. All right, so it is not a matter of somebody telling you that this is what you should do or what you should not do. All right, look at integrity, look at objectivity, look at professional competence, be confidential. All right, behave professionally. All right, so on issue of auditors independence, some things, things are happening in, globally. All right, much of the current thinking on independence has been developed by the Security Exchange Commission in the USA. Okay, that's SEC. All right, so now the SEC approved the following measures. One, the rules relating to non-audit services were revised in cases where the independence of the firm will be impaired if it provided the non-audit services to the audit client. So non-audit services, all right, that can make you to lose your independence. All right, for example, like compilation engagement, where we say the auditor is preparing financials and is also going to audit it. So these are issues that can create problem. All right, rules for the rotation of audit partners. All right, remember we said it that when you are on a job as an audit partner on a job up to 7 years, you need to rotate to cool off for 2 years. All right, as a control. All right, so all these are rules that can help us to achieve audit independence globally. Okay, then when it comes to provision of non-audit services to audit client, we also have this law in America, SOX 2002, Sarbanes-Oxley Act. All right, which was developed, was enacted to protect publicly limited companies that are on the stock exchange in America. So non-audit services that might impair the firm's independence. The SOX lists 9 audit services that are considered to impair the firm's independence if they are provided by an audit client. All right. Number 1, bookkeeping or other services related to accounting, records, or financial statement. So according to SOX, all right, once you are auditing a company, you cannot help them to prepare, you cannot perform compliance engagement according to SOX. All right, this is America. All right, financial information system design and implementation. So the rule prohibit a firm from providing any service related to information system. How can you be their auditor? You are also the one that help them to supply the accounting software. So if there is a problem with that accounting software and the financials are now rubbished, so who are you going to query? All right, so that is the problem with that, and SOX says no. Appraisal or valuation services. All right, all activities are essentially services involving a report from an accountancy firm. The rules prohibit an accounting firm from providing such services. So valuation services, fair value services, you cannot do it according to SOX, Sarbanes-Oxley Act. Actuarial services, all right, for example, in pensions, you may need to come to determine the liabilities of the pension, the assets of the pension. You need to, it's a form of valuation. All right, so which of course is going to still reflect in the financials of the organization. So the rules, SOX rules prohibit an accounting firm for providing any actuarial advisory services to an audit client, all right, that involves a decision about amounts to be recorded in the financial statement. So all this is just to protect the integrity of the auditor. So internal audit outsourcing services, the rules prohibit the accounting firm from providing any internal audit service that has been outsourced by the audit client, where the internal audit work relates to the audit client's internal accounting controls, financial system, or financial statement. All right, so they cannot outsource to you once you are their auditor. They can outsource another auditing firm, but not to you. Management function, we've been saying this, you cannot perform management function for the client. SOX says no. All right, so all these rules are there to protect broker or dealer, investment advisor, investment banking services. The rule says no, it will impair your independence. All right, so that is why a lot of people did not like that law, because it is actually very stringent. Legal services, you are prohibited for providing and legal services. So of course this has addressed advocacy threats. Okay, so that one is removed by law. So that is the power of the regulatory environment. So even if you want to be looking at money and you collect money that will take you to jail, the law will not allow you to kill yourself, to hang yourself. All right, expert services unrelated to the audit. The rules prohibit an accounting firm from providing expert opinions to an audit client for the purpose of advocating that audit client's interest in litigation or in any regulatory or administrative proceeding or investigation. All right, so they are there to help you, to secure you, all right, so that you don't get yourself entrapped while auditing the client, all in the name of making money. So let's look at advantages and disadvantages of the auditor providing non-audit services. Okay, advantages, all right, what should come to your mind first is that the auditor knows the company. All right, because of that knowledge, all right, it can actually help to add value to the company in other areas, so they can give the best professional advice. All right, so because of that knowledge, you should be able to provide additional non-audit services to the client at a lower cost. All right, you already have the audit job, so you'll be able to get other jobs at a lower cost compared to if the client is going to tender that job afresh. So you that you are their existing customer, it will be at a lower cost for them. Okay, then disadvantage, of course, the disadvantage is very, very clear, that is going to there is going to be an independence issue, self-review, self-interest, advocacy threat, familiarity threat, name it, all of them are there. All right, when you are providing non-audit services, and there are case studies in law to actually prove this. Okay, you can check like the one I've been mentioning all over and over. case of Enron and Arthur Andersen. All these entanglements, all right, of all these other transaction, other services can actually entangle an organization, and you are going to lose objectivity at the end of the day, of course, with disastrous outcome for everybody involved. So auditors rotation is very important. All right, within the organization, the auditors that are in charge of the client should be rotated. Even the auditors themselves should be rotated, like we have in Nigerian banking industry. CBN during Sanusi's period says, as an auditor, you cannot audit a bank, all right, more than 10 years. All right, after 10 years, you must leave. Okay, that is, is a form of control. And we say ACCA code 2 of ethics 2, all right, also says that a partner cannot be in charge of an audit more than 7 years. Okay, so that you, after that 7 years, there should be a cooling period of 2 years. All right, so all these are ways that can help to ensure independence, all right, for the audit firm. So this session will look at the accountancy and auditing profession, the current structure of the auditing profession. All right, now the auditing profession now has 3 tiers. You have the big 4, the Deloitte, Ernst & Young, KPMG, and PricewaterhouseCoopers. Those are the big boys, all right, that are in the auditing world right now. Then we have second tier, which are the smaller firms but still with numerous offices and international resources. Then we have the small local firms. So these are the 3 tiers of auditors that we have right now. So the big 4 came from mergers and takeovers, of course, over the years, over decades. All right, they have the resources, they have the expertise, they have the geographical coverage to be able to audit the largest global entities. All right, however, this level of amalgamation has left little choice for the largest clients and little competition for those large accounting firms. So because everybody that has the money and resources will want to be audited by the big 4. Just look at the Nigerian banking industry. All right, list all of them, all right, and check their auditors. You will discover that most likely than not, you will find the big 4 or actually there. So everybody, so it can actually become a problem for the other auditors, all right, that to survive. Okay, because the big business are going to the big 4. Okay, and though one of the ways in which the other small auditors can also overcome that, you two can also amalgamate, you can also combine audit practices, you can also perform a joint audit. Okay, you can also do joint audit to address that problem. So incorporation and the problem of auditors liability. We've said that auditors can be sued for negligence. So if you are sued, then what is going to happen? Okay, to you, are you going to pay, or the auditing firm is going to pay? And that is where the issue of incorporation now comes in. When auditing or profession started, is actually an individual people, all right, actually acting as auditors. So it's sole proprietorship, sole practitioners, and partnership. So because of that, all right, the individuals and partnership, they have unlimited liability. So if people want to sue you, all right, they can actually sue you, collect money you have for the business, collect your personal money, and because of that, all right, it increased public confidence in auditors firm, because the guy is putting his name and his financials at risk. But as businesses begin to become bigger, all right, the issue of risk, all right, on auditors liability begin to become a source of worry, and the auditors were now being advised to take what we call professional indemnity insurance, so that you are paying premium, and if there is any problem, it's the auditing firm, it's the insurance company that is going to pay at the end of the day. And gradually there is now a trend to say, okay, let us remove unlimited liability status of auditors. Why should it be that you can sue auditors, collect everything they have? So there should be a way for us to be able to address that, or even auditors becoming a limited liability company or a limited liability partnership, all right, so that they can only lose their investment in the business. All right, so accountancy practices may be permitted by law to trade as limited liability companies. So we are still hoping that could happen. All right, accountancy practice may be permitted by law to trade as limited liability partnership. All right, so this is allowed able in UK and Nigerian law. All right, so limited liability partnership, they can only lose their investment. Limited liability company, they can only lose their shareholding, worst case scenario, in the organization. So they are personally protected. All right, statute law may place a maximum limit on the size of legal claims against the auditor. So there may be a law that says you cannot claim beyond this. All right, the auditor may be able to agree with the audit client a maximum limit on legal claims. All right, maybe during the when you are writing the engagement letter. All right, so there could be an agreement, a contract, that even if you are going to sue me, you cannot sue me beyond this particular amount. So all these can be used by the auditors to actually address the issue of auditors liability.